On the show today, though, we talk markets and investment opportunities with Rajesh Kothari of Alpha Accurate Advisors. A bit later on in the show, we decode the second quarter earnings of Capsite Infra Projects with its ED Rohit Katyal. We also discuss technicals with Jay Bala of cashthechaos.com. But move on to our guest, Rajesh Kothari of Alpha Accurate, joins us right now on the show. Rajesh, good having you. Thanks so much for joining in. Just first, a quick check really. Every conversation with mutual fund managers suggests that money is coming in droves. Is the same thing happening with the PMS schemes as well, with your schemes as well?
Oh yeah, we have been seeing quite a strong inflows during last, I would say, that started I think 2 years back. And,
yeah, but is it continuing?
Yeah, it is continuing, and increasingly the ultra high net worth individual investors who till now were doing probably trading on their own and kind of leverage, they've understood basically the difference between investment and speculation. So yes, we are seeing good traction.
Chalo. Having said that, let's talk about what's happening with the markets currently and what are you doing. So since you're getting the money, but we're perched at new highs or almost at new highs really, are you selectively investing money right now? Because, and of course I'm guessing you have to, or are you sitting on the maximum permissible levels of cash that you would allow yourself?
Well, if investor who is coming money, putting money today, then we are investing money slowly. We are not putting all money at one go, unlike in mutual funds where you have to compulsorily get invested. So we have a liberty to remain in cash.
Yes.
And over a period of 2 to 3 months, we increase our invested levels. So we select the companies based on which current valuations and so on and so forth, and we start investing.
So what's the percentage of cash levels you're sitting on, and which are the sectors that you're looking to deploy that cash into?
So basically for new set of investors who are coming, say for example last 30 days or so, we are holding on about 40% kind of a cash levels.
Okay.
But for the existing investor, old investor, we are almost like 80, 90, 95% kind of invested levels. So that is as far as your first question goes.
Right.
The companies and sectors on which we are positive, for example specialty chemical. Now this is one segment we have been bullish from last almost 12-18 months. And we keep adding the names depending upon the strong business competitive advantage of those companies. Because the China, it is not a one-off factor, because there is a view on the market that China is like a one-off factor, and as the factories again reopen, the prices again will drop. But actually that's not the case, because even if the factories gets opened up, the cost curve will be different. And therefore many of the Indian businesses which have actually seen huge dumping from China, and although they were strong into chemistry, the engineering side of it, they were not able to make the product competitive in terms of the profitable. But that is no more the case, and we believe that this is going to be the sustainable long-term competitive advantage.
Just a counter question here. Yeah. You're saying even if the factories reopen in China, let's say if the capacities which have been shut down, they reopen, still the Indian companies will have an edge, because there was that gap between demand and supply till now.
Of course, it varies from category to category,
right.
Whether you are into dyes or whether you are into commodity chemicals, whether you are at a value-added side of chemical, But in general, yes, our view is that the cost curve is going to be higher for the Chinese companies, and therefore to that extent there is going to be a structural shift, from China to India.
So where are you putting money within that chemical space? I mean, I'm not asking you to give me a recommendation of a buy or sell, but what do you have in your portfolios which you like or continue to like within the specialty chemical space, because it's a very large pocket? Yeah,
so I'm sure you must have seen our fact sheet, and we are holding for example Ashai Shangwang Chemicals, which is into specialty kind of a company. We are holding, for example, Balaji Amines, which is almost like a oligopolistic kind of a market. There are only 2 to 3 players in India into the amine side of it, whether you look at methyl amines, or there are many chemical what I would say downstream and upstream. So these are the few companies which we are holding. We are holding Navin Fluoro from quite a long time. So we keep identifying companies. All these companies, the names which I mentioned, most of them are like debt-free balance sheets with a 18 to 20% return on net worth, 20 to 30% return on capital employed, and very strong earnings growth of 20 to 30% over next 3 to 4 years. And the valuations are still like below 12, 13, 14 times. Unlike myth that small caps and mid caps have gone up and they are expensive, but actually they are not. Many of them are still available at a quite reasonable valuation.
That is true.
So are you still buying more of the same with the new money which is flowing in, or because I think these commodity and chemical stocks you talked about, you have been one of the early movers into this segment, so you have been holding on to these names for a long time.
True.
Anything else, the new sectors that probably you have started liking off late?
Nothing new. I think we look by company, and nothing much new in terms of the sectoral exposure. But we keep identifying the new companies in the same sector depending upon where is the inflection point from the earnings growth perspective. because many of these companies, they have capacities, but the capacity utilization was running at around 40 to 50%. And that is now increasing to 60 to 70 to 80%. And as that happens, the operating leverage is going to play out very, very strongly. So specialty chemical is one of that example where operating leverage is going to be very strong over next 2 to 3 years.
Okay, so you'll still hold on to these stocks?
Yeah.
Are you taking a call on markets looking at the level that we see now, and there are concerns with regard to the crude appreciating? There could be some tightening, in terms of rates going up in India or US. There are all these fears, and bond yields, if you look at it, have already moved up by some 70-80 basis points over the last few quarters. So are you really worried with where we are in terms of valuation? And accordingly, have you increased the proportion of cash, or are you willing to wait much longer than 2-3 months that you earlier indicated?
Well, I think we look at basically from the company's perspective and the valuations of those companies rather than looking into the broader market, because sometimes it gives you completely misleading indicator. Let me give you for example. Generally Street believes that Sensex earnings growth has been kind of a 2-3-4% in last 4-5 years. But actually, if you drill down the BSE 500 companies, the 1/3 of BSE 500 universe have reported earnings growth of 18%. Over last 3 years, 18% compounded over last 5 years, and 18% compounded over last 10 years. And I'm talking about a 1/3 of BSE 500. And this includes, the Lehman collapse, and this includes the demonetization. So there are many companies in India which are growing at 18-20% compounding. And if you look at the market cap growth of these companies over last 10 years, it has been exactly in line with earnings growth. So they are not actually overvalued. So let's not get carried away by the one Sensex number of 32,000 or Nifty 10,500 kind of thing. Actually, beyond a point, doesn't make much difference. If you think that companies which you can identify has a potential to grow 18 to 20%, and if you get it at a reasonable valuation of 12, 15, 18 times, I think you have still a decent money to be made over the next 3 years.
If I can ask you about, I don't know if you're at a liberty to talk about it or not, but if I can ask you about a couple of themes that I believe you guys bet on. One of them was Shankara Building Products, I presume.
Yeah.
I don't know if you still have the holding there or
Yeah, we still
So, we spoke to the management recently, and he mentioned that his margins would probably grow by about 100 bips over the next couple of years, not more, and revenue growth of about 15%.
That's true.
CAGR. For the next 3.
That's true.
Okay, by the way, I'm just told the HPCL numbers are out as well. And Amara Raja too. Rajesh, just hold on to that thought, because I want to talk about Shankara, but maybe get some thoughts on some of these other numbers as well. Amara Raja, revenues down, EBITDA is marginally higher for Amara Raja. That stock should come up on your screen as well. And therefore, margins are, well, it's a surprise really. I think it's the other way around, quite frankly, but margins have jumped up a bit, and maybe that's why this one has shot up in trade, 6% higher, 724 and counting. So good going for Amara Raja for sure. But I was also told that HPCL numbers are out, so we should be getting them on the screen any moment.
Profit is actually, I think, below estimate.
So we have HPCL already?
So against, an expectation of 2,000 crore, it's 1,730 crores, which is a disappointment. But on the top line front, if you look at revenue, expectation was 53,200 crore, and we are at 54,100. So top line is better than estimate, but bottom line has disappointed, and you see the impact. GRM at $6.75 versus $5.12. So this is better. I don't know what was the estimate here in terms of GRM, if at all
we were expecting GRMs to come in at about $9.7 per barrel.
Then it's just 6 3/4.
It's been below, yeah. And even in the first quarter, it was 5.9, yeah.
Yeah, this seemingly is building like a trend, because a bunch of companies have disappointed on the GRM front this quarter for sure. But this is not the greatest of quarters for HPCL. But as we've been talking about the last few days, don't look at HPCL from this quarter or from the crude oil perspective, because the deal in the offing that everybody's been talking about is probably the larger trigger. I would really be surprised if HPCL shows a really, really big sell-off post these numbers. There are larger games at play in this one. But let's wait and watch. You never know. You could be surprised on the other side as well. But these are HPCL numbers. The Nifty company, ho-hum. Rajesh, your thoughts? I mean, I'm not asking you to comment on the stock per se, but the numbers for HPCL or the oil and gas space at large?
Well, we are not holding much into oil and gas sector, so I think there are many other good companies to play on rather than because the increasing oil price is going to be one of the biggest concern for the market, because ability of the government to keep increasing oil price when inflation moves on the other end, we are not too sure. So
not even RIL?
No.
No, I mean, that doesn't surprise me. I don't know how many large portfolio schemes would be holding RIL. I mean, unless it is a dramatically large scheme, but otherwise, yeah.
No, in
RIL.
the institutional holding was lower at the start of the year, and that's when the run-up started for
Yeah,
Reliance.
but
It was
mutual
kind of-
funds, and only maybe, I don't know if too many portfolio management schemes which would be holding Reliance Industries. And, I mean, I'll be surprised if there are too many, but you never know. I might be mistaken as well. But this is HPCL, and that one is just about trading flat. Amara Raja was the other one. Any thoughts there before we move on to Shankara Building? The battery companies, Exide, Amara Raja?
No, we are not holding any of them. No beyond.
Okay, fair call. Just enough. Just before we take in final thoughts from Rajesh. Rajesh, we were actually on the topic of some retail stroke consumption names which may have looked attractive at the points of purchase but have run up significantly. Shankara being a case in point. Maybe there are a couple of other names as well. What's the compelling reason to hold on to these companies? Is it the growth numbers that might continue for the foreseeable future, or is it something else?
I think there are three things which are important. One is the size of opportunity, which is clearly a very huge for companies like Shankara. You know, what is the current revenue of the Shankara is just about, I would say, 2,000 crores last year. And they are opening new stores, 110 stores already, I think 110 plus now. So the size of opportunity is clearly a very, very huge opportunity. Second is very, very disciplined approach for growth. If you look at any retail player, it's very, very difficult to get a retail player with a 18 to 20% return on net worth. Clearly, Shankara is 18 to 20% return on net worth story. And the third is most important, the valuations, while it looks higher on the nameplate basis, but actually if you look at it and if you look at keep the growth, over next 2 to 3 years, probably it will be 110, 120 crore, which is a very strong profit number for any retail company. 100 crores is a decent number over next 2 years or so. So I think, it is still a good case to hold on to the company. Yes, valuations have run up, but I think it was mispriced, I would say, at the time of listing. So I think it is not cheap, but it is a growth stock, and I think it is a compounder from here on.
Any other multi-baggers or any other stocks that you are doing your research on where you would like to put your money?
There are many companies which you keep.
Your top two picks or top three picks?
Difficult to give stock-specific things, but there are interesting opportunities in auto ancillaries. Okay. This is one space which we have been bullish from last so many years. Motherson is one of the examples which we are holding from almost last 8 years or so, and has been compounder for us. We have been looking at companies in specialty chemical companies like, for example, Balaji Amines, which we added some time back. Ashai Shongwang is the company which we have been bullish on. Again, these are very, very specialized, high specialized chemical companies. I think there are interesting opportunity in the pipe segment. For example, there are companies which are doing return on net worth of 20% plus, and available at below 10 times. So we are looking at that company. So keep watching our fact sheet. You'll find names in our fact sheet. And you can get it at still single-digit P with a 20% growth and 150 crore plus net profit size. So we keep identifying companies. You're
talking about steel pipe companies supplying oil or some other pipe company?
No, pure is a DI pipe players kind of a opportunity, which are really more towards the water side of it, not irrigation side of story, but actually more water side of story. Where, for example, South India, they are growing strongly. If you look at next 3 years projects of government of South India, then water is one of the most important priority for the government. So there are many opportunities like that which we keep getting.
We'll do our research next time before you come and find out which company you're talking about, Rajesh.
Yeah, great having you, Rajesh. Thanks so much for joining in today and giving us your perspective.
Thanks.
Well, that's Rajesh Kothari of Alpha Accurate Advisors.